Thank you guys very much.
All right. How's everyone doing tonight?
Good.
Good. My name is Jake Adams. I'm a CPA. Tonight we're going to be talking about tax savings and strategies. Right? Who likes saving money on their taxes? Who likes keeping more money that they earn? All right. So you can tell I'm not the traditional CPA. I don't have that much gray hair. I have about 30 years on the traditional CPA. And what I really like to do is kind of keep this open and active, lots of Q&A. So feel free to ask any questions. There's no stupid questions. The only thing I ask when you ask questions is just kind of keep it as general as you can so that everyone can take advantage of the question and answer session. So no questions like my great Aunt Margaret sold her house and none of that, right? So anyway, all right, so what we're going to do is we're going to get started on the first sheet, which is kind of the most blank sheet. And I'm going to run through some of the depreciation, some of the tax strategies, tax tips that we're going to be using for depreciation, how depreciation creates tax-free wealth. Anyone interested in tax-free wealth?
Where's my sheet?
Oh, I got to get Gary's sheet. So we got tax-free wealth from depreciation. We're going to be talking about the top 10 tax mistakes. So hopefully you're not making any of those mistakes, and if you are, who's there to help you out with them?
Jay.
And who's there to make sure that you get back on track with tax savings?
Jay.
All right. And then on the back sheet, what are we going to do? We're going to be talking about the 2018 tax law changes. We're going to be talking about LLCs versus S corporations. And then we're going to finish up with selling highly appreciated properties, tax-free or tax-deferred. How does that sound?
Good.
Awesome. All right. So if your questions don't align with there, if we have time at the end, we'll go ahead and take those. If not, I'm going to take Gary's advice and grab a glass of wine afterwards. So I'll be more than happy to answer your questions afterwards as well. Yeah. All right. So who's ready to get started?
Good.
All right. All right. So first of all, let's talk about tax-free wealth through depreciation. So what I'm going to do is I'm going to take out my magic wand and I'm going to magically create this thing called depreciation, right? What is depreciation?
Driving the car off a car lot.
So there's actually many different examples of depreciation and ways that we use the word depreciation. So that's a great example of depreciation is as soon as you drive a car off the lot, what could you resell it for, that depreciation in value. In real estate, depreciation is what the IRS gives you for deduction. So the depreciation deduction. Now does anyone know what the depreciation deduction is for rental real estate? 27 and a half years. We got some seasoned vets over here. Thank you. All right, so rental real estate is 27 and a half years. Pen's not working very well. And then what is it for commercial properties?
40.
30, 40?
I think it's 40.
Is it 40?
Yeah.
39? Yep.
39.
So 39 years for commercial. So I'm going to use some more pens. So when we're looking at investing in residential or commercial, what do you think? Thank you so much. What do you think is going to give us the biggest tax benefits?
39 is bigger than 27.
39 is bigger than 27, right?
27.
So the 39 is actually the 39 years it takes for the commercial building. So what that means is if you spend $39,000 on a commercial building, right, you're going to only get $1,000 a year for depreciation. But if you spend that same amount on a residential, you'll be able to depreciate more, almost about twice as fast. So you'll be able to depreciate upwards of $2,000 a month, right? So what does depreciation create? Well, depreciation creates tax-free wealth. Because essentially what you're doing is you are getting a deduction for something that doesn't exist. Right? Depreciation really doesn't exist. It's just an IRS deduction that they created. So what's happening essentially is you're getting a tax write-off or a deduction for an estimate, right? So what's the best thing about real estate as far as residential or commercial is that you don't have to put all the money down for it, right? Is there anyone here that's purchased a property without any money down, completely cash-free? Yeah. So in that case, if you were to acquire property with no cash out of pocket, and it was your property and you were depreciating it, would you essentially be able to get an unlimited return on investment because you didn't put any money down and yet you're getting a tax break for it and potentially income from it, right? Can anyone think of any other investment that you can do that you can get unlimited return on investment?
Sorting Tesla.
Well, you still have to put some money down for it, right?
Oh,
Yeah.
Yeah. So this is, and in my opinion, real estate is the best investment that you can make because of the deductions that you can get. Where basically the IRS is willing to give you a deduction for something that really doesn't even exist. It's just an estimate. And it could be someone else's money, right? So has anyone ever put down 20%, 30% on a rental property? Yeah, right? So you're getting the depreciation deduction for money that's not even yours, right? So someone else gave you the money and you're getting the tax write-off for it. Pretty cool, right?
Don't you have to pay that back
Yeah,
when you sell it?
right, but there's the gain when you sell it, but as long as the property doesn't depreciate and decrease in value, then you're going to always come out about break even, right? Because the property should increase in value, appreciate in value, right? So are you referring to depreciation recapture? Yeah, we're not going to go into that. That's too thin. But the thing is you're taking a write-off for it now, and yeah, you got to pay tax on it later, but you're getting the tax free now. All right, so that is the depreciation. Now, what other things can you write off on a residential real estate? Let's say, what's that? Maintenance.
Mortgage interest.
Mortgage interest, property taxes, right? So there's a lot of things that if it costs you money out of pocket, you're going to immediately get a tax write-off for it. So as long as you're positive, cash flow positive from the property, from the rental property that you have, and you have depreciation to cover that income as an expense, then it's completely tax-free. Right? How does that sound? Okay. Now we talked about building wealth. Is building wealth important for anybody here? Right? So what things can you do with rental real estate, whether it's a single family home or a commercial, that you can't do with any other kind of asset to build wealth? Has anyone heard of a 1031 exchange?
Oh, yeah.
Right? So a 1031 exchange will allow you to take the amount that you've created here and shift it into something else, right? I want to grow bigger. I want to have more. Bigger, more, bigger, more, bigger, more. And that creates wealth. Yes?
Can you do 1031 exchange with two properties if you took that money and split it into two properties? And
Yeah.
combined it?
Yep. Yeah. Yeah. And a 1031 accommodator, there's a couple locally that are really good, and they'll walk you through all the questions that you have about 1031 or about trading up these properties, right? And so what's really important is this will allow you to accumulate wealth. And do you have to pay taxes when you sell it and then move it into something else? No. So the 1031 allows you to accumulate real estate and build wealth. Now how cool is that? Right? Do they let you do that with vehicles? No. Do they let you do that with airplanes? No. Not anymore. Do they allow you to do that with stocks or cryptocurrency? No. They put the kibosh on that with the 2008 changes. So real estate is really the only thing now that we can do 1031 that's going to be able to accumulate and build wealth like that. Make sense? Cool. All right, so the magic of depreciation, right? How can depreciation get even better? Anyone? Leverage.
Yeah.
Yeah. So leverage, you're using other people's money to get the tax write-off, right? But we can actually accelerate depreciation or get more depreciation, right? Has anyone ever purchased a commercial building? Okay. Yeah. So if you purchase a commercial building, right, let's say you bought a building for $2 million. You bought a commercial building for $2 million. What are you really buying for $2 million?
The rents.
You're buying the rents, right? But you're buying everything. You're buying the carpet. You're buying the drywall. You're buying the electrical. You're buying, the plumbing, the shrubs and the bushes and all the concrete outside, right? Right? So does that stuff last for 39 years? No, of course not. So there's this really cool thing called cost segregation. Has anyone heard of cost segregation analysis? Okay. So cost segregation analysis are really cool. I pitch them because only CPAs can do them. And they're a great way for us to make money. But essentially what they do is they allow you to look at each individual asset that you're purchasing, and you can depreciate them faster, right? So how long does the carpet last? 5 to 7 years, right? How long does the whiteboard last? How long does the chair last, right? If I'm buying everything, I'm buying the chairs and the table and the blinds, right? So some of that stuff lasts 5 or 7 years, right?
6 months.
6 months, yeah. We'll probably want to change those out. They're kind of ugly. The shrubs and stuff like that, 15 years, right? So what we're going to be doing then is saying, well, we're paying, let's say, $2 million for the building. However, there's a lot of stuff in here that we can write off faster. So instead of taking the $2 million over 39 years, which takes a really long time, what you're able to do is say, well, the carpets, all the carpets and all the rooms are $2 million, or let's say $20,000. And then the computers and the chairs and the tables and stuff like that is $30,000, right? And then you can take that and depreciate that over 5 years or 7 years instead of over 30 years. How cool is that?
Very cool.
So what does that do? Well, that increases your expenses, right? It increases your depreciation expense. Remember that the magic wand and creating this expense out of nowhere? So the cost segregation analysis says, well, we bought this whole building, but we bought everything inside of it. And we can accelerate the depreciation. We can take depreciation faster on some of that stuff. Is that cool?
Yeah.
Yeah.
I have a question, Jim.
Yeah.
If the tenant paid for the improvements, do you still get to do the depreciation like that?
It depends, and it's different situations in different cases, yeah. Yeah, James?
So, are normal expendable items included in that, like light bulbs and everything?
Yeah, because when you buy a building, you're buying everything, right? So yes, you can even go through and say all the light bulbs cost $400, $500, right? And you could depreciate those faster, right?
You put in really nice light bulbs.
Yeah.
Like light bulbs, right?
Yeah.
This is only for commercial, right?
This could be for residential too, right? So, and this is a great example for residential. I just said commercial, but you can do the same thing with residential. So let me give you a scenario, right? I'm going to give you $10 million to invest
Okay.
in property. Or say $1 million to invest in property. 10 million, too generous. $1 million. Now, you can take that $1 million and you can spend it in San Francisco, here in Dublin, or in Stockton, right? What are you going to get for $1 million in San Francisco? Yeah, so closet, right? So probably like a 2-1, right? Like
Maybe.
Okay.
1-1.
Depends on what part of San Francisco. Okay, what will you get in Dublin? Maybe a duplex, right? So a duplex you're getting 2 times 2-1, right? And then what would you get if you went out to Stockton or Fresno?
5.
You get, let's have 5-plex, right? So you get 5 2x1s. So what happens when you're looking at cost segregation and depreciation if you buy 1 unit? You get 1 dishwasher, you get 1 oven, you get 1 set of countertops, 1 set of cabinets, right? So what does that do? It gives you 1 of those things, right? If you buy a duplex, what do you get? 2. What if you buy a 5-plex? 5, right? So if you want to invest that $1 million for tax savings, are you going to buy in San Francisco,
No.
in Dublin, or out in Stockton? Stockton, right? So do you see how that works? Does that make sense? Yeah, because you're getting 5 times the amount of depreciation. You're 5 times the amount of stuff that you get to accelerate that depreciation. Now, if you look and you notice larger corporations, right, when they're holding property, especially commercial property, what's the average length of time that they're holding property for?
5 years.
5 to 7 years, right? Now, if I told you that the average depreciation on a chair, on a table is 7 years, would that make sense why these large companies are flipping these properties every 7 years, right? Because what they're doing is they're accelerating the depreciation. They're taking most of it in years 1 through 7, taking as much tax-free income as they can, and then once the depreciation kind of slows down in year 8, what do?
Sell it, get another one.
Sell it and get another one, right? So then if you sell that one, or 1031, sell that one, move it into another one, you get more what? New stuff, right? Make sense? Cool.
I
Yeah.
want to say a $500,000 house around here. How much would the cost segregation write off? What would you'd have the appliances and some other things. Of the 500, say, what would it be?
Right. Well, it all depends on the value of all the appliances and the countertops and the cabinets and everything like that, right?
For a typical number.
It all depends.
10%,
Yep.
10%, 15, 20%.
So cost segregation analysis is actually to go through and say this is exactly this price and this price and this price, and what it does is it does that.
So can I say, it doesn't have anything to do with the value of the property. You're asking about a $500,000 property, right? Am I
Yeah.
correct?
Yeah.
Right. So it doesn't matter if it's 500,000, a million, 5 million. It's the cost of the stuff that's in it.
Exactly right. So it's the cost of the stuff that's in it. Yeah.
But this only works for rental property, right?
Yeah. What else would you want to do with it?
There's nothing you can do with flipping houses.
No. No. Yeah. So this is a buy and hold
Right.
situation. Yeah. But it allows you to accumulate wealth, right? Okay. All right. So yeah.
Are you able to depreciate the entire value of the purchase or land?
So land is not depreciable because land never expires, it never goes anywhere. So land is the one thing you cannot depreciate. Yeah, good question.
Yeah, I know that's right.
Even if it burns, it can't burn down. It's still there.
If it falls in the ocean.
Yeah.
That's next week. Been reading, Bill.
All right. So with 2018, and I'm going to kind of jump ahead. I said I was going to cover 2018 later. Hold on just a second. So with the 2018 changes, if anyone noticed, the bonus depreciation used to be 50%. Now they bumped it up to 100%. So if you purchased a residential rental and you needed extra depreciation expenses, you can actually do what's referred to as bonus depreciation. And bonus depreciation will actually give you the ability to write off 100% of some of those expenses. So tables, chairs, computer equipment, anything basically 15 years or younger in depreciation terms, you could actually write off up to 100%. So because of this, buying rental real estate has never been a better tax move and has never created tax benefits like it has before. Yeah?
With regard, if you started a depreciation schedule, can you change it to this cost segregation later on?
Yeah, that's a great question. So the next one that we have here is if you have depreciable property already in service, Form 3115 can claim back missed depreciation deductions. Right? So if you haven't been taking the accelerated depreciation and you want to, or you were working with a poor CPA or poor tax professional or H&R Block, and they weren't taking depreciation, you could actually go back, fill out the Form 3115, and get all that depreciation that you missed. Right? So if you were actually coming into a large capital gain or a large gain situation this year, and you found out about this 3115 form, you could actually say, oh, I forgot all this stuff that I could have done the past 7 years. Hey, I'm going to do that right now.
You can go back 7.
Yeah, you can go back up to 30 years. And say, hey, I missed this. I didn't do this. I forgot. I should have done this. So the 3115 will actually let you take everything in 1 year.
Okay, so it's only that 1 year. You can't do it the next year too.
Correct.
Okay.
It's got to be 1 year.
Depreciation is over time, right?
Yeah.
But
So
this is it's a one-time shot.
yeah. So basically it's saying, oh, I should have done the cost seg analysis, or hey, I should have depreciated this, or hey, I wasn't taking depreciation at all. Let me do that. Right? Yeah.
I assume it was based on the tax rules that were in effect at the time.
Yeah. Yeah.
So it's a one-time shot because it's in the past, right?
Exactly right. You're basically saying I made mistakes in the past, so now I'm fixing it now, this year.
But if I'm doing it for this year, for this stuff, I do it, and then next year I get to do it for the same stuff? For that year? No, I only get it once.
1 year. Yeah. Yeah. Yeah.
You need, what, your receipt from 15 years ago?
If you get audited. If you get audited, you need receipts for everything, right? Yeah. But yeah, it just has to basically like, why are you doing this? What is the reason for it? And if you miss something and you're now catching up because you missed something, that's totally okay. The IRS has no problem with that. Is that depreciation pretty cool?
Oh, yeah.
Right? Is it cooler than it was before?
Isn't it?
Is this depreciation much cooler than driving the car off the car lot?
Way better.